Hello, everyone. Welcome to Topline, episode 85. It's Sam Jacobs. I'm joined by Asad Zaman, CEO of Sales Talent Agency, and Peter Walker, filling in for AJ Bruno, the Chief Strategic Officer for Carta.
Oh my God.
And the senior...
Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
CEOs and founders, this is your chance to connect and grow in an exclusive CEO and founders-only environment. Pavilion's CEO Summit 2025 is happening January 22nd and 23rd in New Orleans. Forget theory. Our action-packed workshops deliver tangible takeaways to drive your strategies forward. Plus, with Pavilion's connections-first approach, you'll build lasting relationships rooted in collaboration, growth, and support. Reserve your spot now at joinpavilion.com/CEO Summit and join 150 plus high growth CEOs for 2 days of insights and meaningful connections.
I'm just continuing to invent new jobs for you, my friend. Anyway, Peter's filling in for AJ because AJ is busy. We're not sure. What is AJ doing, Austin?
AJ has a leadership offsite. So he's flown somewhere again and he's hanging out with his team, and he does a lot of traveling and a lot of hanging out with his team.
All right. Well, fair enough. Well,
have we investigated the ROI on hanging out with your team?
We're going to find out at the end of the year. AJ is going to give us his numbers, and we'll see. We'll see.
Good.
Peter, how are you?
I'm great, Sam. I'm getting promoted every 2 weeks based on your intro.
You're getting promoted every time you come to Topline.
It's exciting. No, it's life at Carta is good, man. Happy to be here.
All right. Well, we're glad to have you. We're going to be talking about some of your research as usual. Asad, are you doing all right? You're having a good Q4?
I'm having a great Q4. I started shaving with a straight blade razor as of this morning. So I cut myself in 5 places.
Like a long one? Like
what's the point?
But it's a cleaner shave. Like it's like closer. That's why you get cut. But I enjoyed it, so I'm happy today. And Q4 is really good. This was Q4 in our business. If you look at it from a cyclical perspective, is the one quarter where things slow down a little bit and then they really pop up in Q1. This is the busiest Q4 we've ever had since I've been in the space, and it's been 10 years now. And so nothing to complain about from my side. I'm a happy camper.
What do you think that means?
I think it's us. We've done a good job in building partnerships with investment companies this year. So I've spoken about this before, that we don't have an outbound sales team, and we're very much focused on doing a good job, having relationships with the right people, and using the quality of our work to get introduced in other places. And that focus has helped. So at the start of this year, we might have had 150 billion in total assets under management with the partners we had. We're close to $1 trillion now. All of them have been referrals. And the work that we're doing is allowing us to go deeper and wider into those accounts. And so I think part of that is that, like, we've done a good job there. But I also think the market's a lot better, and companies they've shifted from, I think, playing the game on defensively. Even the hiring they were doing was defensive hiring, to playing the game on the front foot now, thinking about growth, thinking about expansion, opening new channels. I've had 3 conversations in the last week with companies that are doing more than 100 million in revenue, and they are all adding a brand new channel into the equation. And that wasn't the type of conversation we were having last year. So I think it's a combination of market and us, and I'm very happy about that.
I'm trying to think of a way to tie your straight razor shaving into the state of the market. Like 24 was a year of nicks and cuts, but we'll be cleaner. I think it fits. man. I think it's pretty good.
I think it's a front foot move, right? Like you have to be a little bit proactive in life to decide to shave with a straight razor, and that's how companies are about.
He's coming into his own. That's what I think. He's developing his own style. He's going to be wearing a fedora at some point soon, or
100%.
Maybe he'll have a monocle. Right?
Maybe a monocle. I don't know if I'm going to hide my hair under a hat, Sam. Like my hair's
like
too nice for that.
I'll go with the monocle. A chain, a watch on a chain tied to your suit.
I don't know anyone who wears a monocle. That would certainly stand out.
Idiosyncratic.
I had an uncle, by the way, in Pakistan who used to wear a monocle, and it was really cool. Like he stood out. He had a cigar, monocle. He had like those sticks.
I feel like in the States, the Monopoly man has sort of ruined monocles.
He was like the Monopoly man
that you want. Exactly.
You can't really name your kid Adolf anymore either.
Yeah. Exactly. Oh my God. Jeez. Same time frame, but like,
how did we get that? How did we get that?
Nice.
You never know what you're gonna get.
People have ruined the Monopoly guy.
You never know what you're gonna get.
Yeah.
Well, let's segue into the docket now.
Sounds good.
Peter, great to have you. It was really enjoyable to read the Q3 market report, because at the end of reading it, I felt like the market has stabilized and is trending in the right direction. Like that was the overall feeling I got. And so maybe let's just start by you framing the situation for us based on all these various data points that you guys published. How are you feeling? What's the vibe of your look back on 2024? Like what was 2024 finally like for this market, and how is this informing your general worldview of 2025? Broad question. Let's start there.
Love it. I think the context of 2024 is actually how I now feel about 2023, which 2023 was the bottom, right? It was where everything turned from the joyous times of the boom in 21 and early 22, and then the decline in late 22, basically all the way through 2023, and just kind of this mishmash of data that didn't seem to make much sense. I completely agree with you about 2024. It feels like if I were to put one word on this year, it was consolidation, right? Mm-hmm. Like we're no longer falling. Many of the metrics that you would track in order to judge the health of various startups, down rounds, et cetera, they've stabilized and started to trend down. And it does feel like 2025 is a year for cautious optimism. I don't want to paint it as though we're going to get back to 2021 sugar rush levels of investment or fundraising pace, but I do have pretty strong confidence that we're going to get back to healthier levels of investment. And then the real unlock for this whole ecosystem, as you all have discussed numerous times, is liquidity.
Yeah.
And if IPOs, which, Service Titan, others filing, like kind of feels like 2025 is an IPO year.
Yeah.
And M&A is close to as high as it's been. Now, we can talk about whether or not those are quality exits or just kind of acqui-hires and fire sales. But in general, I just feel like the options for liquidity are becoming more real over the last 6 months. And I'm so excited for some IPO to sort of take the lid off of that part of the market.
Do you think the Service Titan IPO, the Klarna IPO, those are the two announced, right, in the last couple of days? Like, do you think it's going to be one of these or a combination of these IPOs back to back? Or do you just think it's going to be like this slower, consistent, every quarter we'll have a few, and we'll just notice at the end of the year that this was a year of liquidity and the market did benefit from all of these IPOs, but it won't be any one IPO that'll just like switch everything around?
Look, I think there are potential IPOs that could be strong catalysts, but in general, my view is probably more towards the former there, where you have drips and drabs. I mean, if you looked at I think it was, I can't remember, maybe Coatue put out the technology IPOs over time. It's like, we did 140 in 2021, and then we did 18 or so, 14 or so total from 22 to 24. I mean, it has been dead. Completely nothing there. So like a drip of a couple a quarter, or even 4 or 5 a quarter, would be great.
Well, I also think obviously, I don't know if I want Dr. Oz running whatever he's running, Health and Human Services, or I don't even know. It's totally insane. But, Trump is much more focused on deregulation and sort of opening up and loosening up capital markets. Yeah. because I think we talk about IPOs a lot and we bring it up a lot. And I just think I think if we want public companies, great public companies, if we want companies like Stripe to be public, then we need to give them a reason to be public. And there needs to be some kind of environment that makes it appealing to IPO, because if you can get the same level of liquidity or some level of liquidity by staying private, then why would you ever want to go public in the first place? I'm hopeful that, a new administration takes a more sophisticated. I'm not saying that Biden is anti-IPO, but I'm just saying that we need some kind of framework that says this is why companies should be public, and we want to create an environment where we're lowering the cost of that. Because as far as I can tell, costs of going public have only to increase.
Yeah.
I don't really think that there's been a full positive case for going public that's been made by any credible person in a while. It is, Sam, to your point, it's a missing piece of the narrative, right?
Where there's been a bull case made for not going public, right?
Yeah,
Like
for
if
sure.
you look, Databricks just announced. So OpenAI's last funding was the highest venture round ever. You can question whether you can even call that a venture round, but it was the largest fundraise ever by a tech company privately. And now Databricks is breaking that record. And just a few months later, I think they're about to do a $7 billion round. And this round is similar to the Stripe round that happened, where they did it specifically to give their employees liquidity. And so if you think about the case for staying private, is you're just not under the scrutiny of the public eyes and the analysts and them understanding your business and saying nice things about you. The interest rate matters less in the private market than it does in the public market, especially when things are not moving up and to the right. The trash and the effect of that within your businesses, the scrutiny that your employees put on you is quite significant. You don't get that same level of scrutiny as a private company. And so you get to build in private without these watchful eyes, and you have access to the type of capital that you just never had access to before. So there's now this new case for just stay private and keep building. When we look back, we'll say maybe the fact that Databricks was private and Snowflake was public made a difference in this category war, in which now for the first time since 2010, since they've been competing, Databricks is now the higher valued organization. They've taken over the category leadership there. And so maybe this public versus private played a part there. And so we do need a case for going public. We need some to go public and for there to be some nice pops and liquidity in the market, but we also need some deregulation over that. What about, Peter, when you look at this overall, there's M&A, so you've got strategic acquisitions, you've got private equity that's buying companies, and that seems to have been quite active this year. Sam had said that 2024 will be the year of M&A. It does seem like it was the year of M&A from everything we're seeing, even outside of tech. Outside of tech, it was one of the best years for M&A historically. You've got these large businesses that haven't been able to acquire the same way, but that might actually change with this change in administration, and then the public markets open up. So when you look at all those things coming together, is that your case for higher liquidity? It's like these three things intersect versus any one of them kind of is the big boom?
Absolutely. Plus the additional sort of hidden layer of secondaries, which plays a role, as you've already spoken about, in the late stage privates being able to remain private because they're able to provide secondary liquidity for their employees. But it's actually broader than that. There's been a lot of activity both on the direct secondary side, company tender offers and events of that nature, as well as fund secondaries, like parcels of funds being traded around. That's been much more active this year than it was in 23. I'd expect it to get more active in 24. One of the weird parts, there's a 100 weird parts about venture, but one of the weirder ones is that companies that are in the venture model have to respond very quickly to changes, whereas funds, you have a 10-year lifetime on this fund. Like the actual pull through of changes to the fund structures doesn't get shown as often as quickly. So funds are still dealing with all this valuation overhang from the last couple of years. It'll be interesting to see if, for instance, 2025 sees a return to funding emerging managers in a way that hasn't really been very much in vogue over the last, call it 18 months or so. I hope that happens. I think that we need venture funds of different sizes. I'd almost call the biggest venture funds, like OpenAI didn't raise a venture round. That's like I don't know what that is. That's like a sovereign wealth
Yeah. That's like a growth.
Like whatever the
growth
word
equity
is,
test.
it's not
Yeah.
the same as a Series A fundraise, right?
Yeah.
These are like two completely different worlds.
What
I
about like?
think just to add on to that point, because I did say it was. Here's what I'll say from personal experience over the last, which I've shared with you privately, Asad, which is that it is a year of M&A. It's just not the year of good M&A. And I think that the private equity shops are out in full force right now, and they smell blood in the water. And I think we were on a private, me, Asad, and AJ were talking, and AJ was saying, now is not the time to sell your company, even if it is the year of M&A. There is liquidity available at discount prices. And that doesn't mean that your company is worth 10 times ARR. It just means that you don't want to sell at the beginning of the incline. You kind of want to time it to sell at the peak if you can. And you need a little bit of mania and enthusiasm in the market if you're trying to reach a local maximum. And I can tell you that, I've gotten more private equity outreach in the last couple of weeks than I had previously, but all of it clearly at, effectively bargain basement prices of, telling me that, I'm worth 1/10 of what. I mean, it's not even, and what does worth mean? Because it's sort of at this moment in time, I'm probably not worth, whatever I aspire to be worth. But the beauty of controlling the company and running a profitable business is I can keep building and wait. And it is also fascinating to me how closely, and we've talked about it a lot, but like how closely our business performance tracks the economy, even though we're not aware that we're in the economy all the time. So, Pavilion had a shitty 2023, or sorry for swearing, kids out there, but a bad 2023, and then a better 2024. And it's almost exactly mirrored in your, in that chart that I was looking at in your report, Peter, where it's like, we may never get back to the 2021, where it's that one massive blip, this huge, but then you have this, and I think you called it relative stability. It feels like the new normal, where, and I don't know if it's like $20 billion a quarter that's deployed, something in that neighborhood. And that gives me, some level of encouragement at the same time that, like, it's M&A at low multiples, which isn't quite the same thing as, the M&A that we're all hoping for and looking for.
It seems like it's more of a signal that things are moving in the right direction, that outreach is happening, because then we can look back at history and say, okay, how do these economies function? And there's this cyclical nature to an economy where there will be a boom, there will be a bust, and there are these periods in between. And it seems like this is one of the leading indicators of you're done with the worst of it, and you're starting to now get into this period of time that can be anywhere from like 3 years to 10 plus years, where things are going to start moving in the right direction. So it can give you some encouragement. It can give you some peace of mind that we're out of the thick of it, because it's really hard. Like, it's hard emotionally, physically, mentally to do business in the thick of it. And just to see these little signals that, yes, it's not this. You might have seen some benefits in your P&L in the last couple of quarters, but it's not just you. There's an environment that's improving, and now you can think about life in a more proactive way. I think that's what I take away from it, because you are 100% right. Like, if a company can wait, you should wait till the peak. That's where you want to sell. But now
timing the peak is a little difficult, though, isn't it?
Yeah, timing the peak is really, really hard.
But I guess we can define the peak as wait till you raise your own eyebrows.
Yeah,
you're like, I don't
Sam,
know.
are you saying that none of these bankers, none of these private equity folks singed your eyebrows with offers yet?
Just more like, you know what? I don't even know if we're worth that. I better take that deal.
That's a ridiculous number,
The
guys.
moment you think, well, I wouldn't pay that for us, then yeah, you should definitely take it.
Really?
Yeah, exactly. That was what 2021 was like. Really?
Yeah,
Okay. I'm not going to spend a long time arguing with you.
I remember talking to founders that had just raised rounds in 2021, and I'd asked them about the process. And it was in martial arts, we have this thing where at the early days of the UFC, there wasn't much testing for steroids. And then they became a little bit. And we used to joke that they would do the sniff test. They just sniff you and be like, you're okay, and you can fight. And that's how companies were doing due diligence for rounds in 2021. It was the sniff test. Like, there was a handshake, there was a quick conversation, there was a coffee, you get like 30, 40 million. Sometimes like people hadn't even asked for anything much in return. Like, the Tiger rounds were wild and insane to hear about, especially from the founders, because they'd been used to raising funds for the last 5-6 years, and which was like pulling teeth and chewing glass. And then like then this happened. And so that was madness. And so I think you just wait for that. The other thing that
By the way, that is exactly, I love them both, but that's exactly the Chili Piper story, because they were grinding and they were like, we're just going to be a bootstrap business. And then Tiger walks in one day. He's like, well, we think you're worth $500 million.
like, okay.
Who am I to disagree with you?
You're the experts. I'll take your word for it. Yeah.
I was thinking just that. I love venture. I think one of the
did you just slip in that you fight MMA? Was that a flex?
No, I didn't fight it. I trained, but I never fought for it. Like I
did say we have this saying in martial arts implying you're some kind of black belt.
Well, I'm in martial. I can say I associate with the martial arts community. I don't associate with the UFC community. There's this interesting thing I've been noticing in the market, which is this idea of, are we back? So I saw this one company publish this report, and literally the report was like, we're back. And then I heard somebody else yesterday say there's an epidemic of quota attainment in sales. And I'm starting to realize, like, this idea of going back seems to be a dangerous idea. Because what does it really mean? What are we going back to? Like, are we trying to get back to 2021? Like, I don't want to be back in 2021 immediately. Like, everything we dealt with after was because of where we were there. So it's not like this healthy place to go back to, especially so soon after what we just dealt with. And markets, they have similarities every year. If you can bucket markets in 5 years, they have similarities, but they're also very different. The size of the tech ecosystem is very different right now. So we're never going to go back to that. And then the epidemic one was interesting because it, again, like had this connotation of one, back in the day, it was good. We need to get back to that. And it's like, well, we have no historical data on tech quota attainment. Since I've seen it, it's been at these numbers, give and take, a few percentage points, and maybe this is a steady state. And so, Peter, curious to get your thoughts on this, like this going back idea. Like, are we trying to get back to something, or is this just going to be a new world that we have to get used to?
I mean, I really deeply hope it's a new world and we're not going back. I think that Sam's, consistent drumbeat on this is one that I have taken up myself oftentimes around the difference between now and 2021 is the advent of capital efficiency and bootstrapping. There are so many businesses being built today that would have tried to take venture capital in 2021 that, for whatever reason, either by choice or through many, many, many no's, have been forced to not do it, and they're probably healthier for it. And that actually begs the question longer term around what is VC for? As we've just mentioned in this conversation already, the asset class has grown so much, and there's so many different parts of it that it feels difficult to speak about VC as one holistic, monolithic thing. And I wonder if 2025 is a year where we're going to need to start either inventing new language or at least being very specific about what we mean when we talk about different parts of the startup ecosystem, because it's all over the place. And I mean, we meet with founders every day and they're building these things and saying, maybe I do the indie VC model of $1 million or $2 million and try to see if I can get to $1 billion with that, or take no money and see where it comes. I can always talk to VCs once I have 10 million ARR. There's all the models are like up in the air at the moment.
I couldn't, I remember because I grew up reading Fred Wilson in New York from like 2002, 2003 through, I guess whenever he stopped blogging every day. But the point is, like, he had a very defined point of view on what VC was, on how big it could be, on how it was going to be a craft industry no matter what, and it didn't really respond to new capital, and that the entrance of new managers wasn't going to do anything to create more good companies. And so you were saying, like, do we think there's going to be more emerging managers next year? Or is there going to be, and I don't think there will be. I think there will be continued, especially to the extent that there's consolidation in the VC, in our broadly defined ecosystem. I think the question of what is VC for is a great question, because if we go back to the original definition, it's like to fund, it's the most generous form of capital in many ways. I mean, even with preferences, even the reality is there's people that are cutting multi-million-dollar checks to people with an idea, not that much track record, not that much work experience, all in the hopes and prayer, and guiding them through the process. And the reality is it's not private equity, and people still got rich doing it. And which is still pretty amazing because you got 20 somethings and 30 somethings walking into the lion's den, and the VC industry is sort of designed to, on an all things considered basis, to be pretty fair when it comes to like who gets their money back and how they get it back. But the reality is, like, especially in this new world where it's much cheaper to build a company and where bootstrapping is more viable and where there's so many different point solutions, it's really hard. I mean, again, that doesn't mean that there's no billion-dollar outcomes. It just means that I just suspect, my guess is that the constraining factor of billion-dollar outcomes is the size of the human population and not the size of the capital markets. And it's probably like more closely correlated to like literacy rates in the world coupled with fertility rates than it is with like, how like putting $1 billion more into the venture ecosystem will not create that or I guess that would be that would be what 5% more per quarter. Like you put 5% more per quarter, do you get 5% more unicorns? I think we've seen that the answer to that question is no, you don't. No. And so, like, well, what is the thing that will produce more unicorns? And if you listen to this our show a lot, Peter, you'll hear me. I've said this a lot as well. More babies. I think that what we need are more babies and more and a higher standard of living for the global. And that's the thing. I can't see another thing that will create more unicorns. And because all Western economies have declining fertility rates, I know that this is like a big macro perspective, but I really don't see how there's going to be more like a higher. There's not more geniuses being created by definition because there's fewer humans being created in general. Right. So by definition, there should be a correlated falling amount, and especially because it doesn't take as much capital to. Now, obviously, if you're OpenAI, like you need billions and billions of dollars, but most companies don't need that. So you have this conflating forces or compounding forces of the fact that you've got fewer people, and then the money that they need to build a great company is less. And I think both of those things. I don't think it hurts Fred Wilson because I don't think that he changed his perspective on this ever, which is like it's always going to be a craft industry, and people are going to come and go, interlopers basically, and the bridge and tunnel crowd, and then they're going to go back to Jersey. But I'm going to still be here, and I'm going to be picking one or two winners every couple of years that'll become Foursquare or become Twitter or become Coinbase or whatever.
Yes.ai enables your CEO, subject matter experts, and other senior leaders to engage prospects directly, creating meaningful connections and boosting response rates. With just one click, your team can strategically involve senior staff to make your outreach more credible and effective. Empower your GTM team to orchestrate your outbound process and say yes to yes.ai. That's YESS.ai.
Scanning my brain for an analogy for new humans that aren't, can we have an AI SDR, but for babies? I don't think it exists. There's, I think your point is well made. Maybe the other outside perspective is just on a macroeconomic level, if you are being competed away, if all the margins are being competed away in other asset classes, is this the asset class that has at least the potential for outsized margins still? And that drives so much capital into it that it actually ruins the margins for everyone, right? It's sort of the tragedy of the commons over time there. I think that almost certainly is happening. I mean, look at the professionalization of parts of VC. We didn't have the word pre-seed 7 years ago because it wasn't a part of the market. It was just founders flailing around, and then they got big enough to be attractive to some VCs. And now that part of the market has like playbooks and roadmaps and milestones and everything. So it's the professionalization
that
of all
only specialize in pre-seed. I'm a pre-seed specialist. Wow.
Yes.
So
exactly.
valuable.
I'm a all these names are so kind of annoying occasionally. It's like I'm a pre-A seed plus investor.
Yeah.
The pro rata of the seed round of someone between 1 and 2 million ARR, blah, blah, blah. And it's like at the root end of the day, to Sam, your point, if it is a craft business and there's only ever going to be so many of these companies that make it, then a lot of this is just kind of like moving money around in different piles.
I guess the other opinion to that, though, is that if you look at so venture started when It was first called Adventure Capital, which I think is just the best name. I wish they'd stuck with that, but it eventually transitioned to venture capital. But
It was adventure capital when it was whaling, right? Where the adventure was you're going to get killed half the time on this boat.
that was part of it. Yeah.
Christopher Columbus was adventure capital.
Yeah,
Of
sure.
adventure capital, right? And so I think what has happened though is that if you were just to take two charts and say the amount of money invested by LPs into funds on one chart, and on the second chart, the total enterprise value of the ecosystem, as one has gone up, the other has gone up. And so one could say that we are now at this inflection point where there's depreciating returns of the extra capital that's coming in. We've hit this inflection point because that up till a certain point, there was more capital. More capital could be put to work in a somewhat efficient way. Doesn't mean everybody was going to win all of that, but like in somewhat of an efficient way, if you were to look at net enterprise value and net capital invested by LPs, we seem to be hitting that inflection point. And that happens in a lot of asset classes, right? Like when the returns are good, there becomes exuberance. And so more capital goes in, then can be put to work efficiently. And so then, there has to be some form of a correction. And people would argue, well, maybe the fact that AI makes building things easier will mean there's even more companies, and so you can put more capital to work. And the counter opinion to that will be that, well, if building things is easier, maybe those companies won't be needing the same type of capital. Maybe companies will go this different route. They'll go the bootstrap route, etc. So I think it needs to be figured out. But historically, more capital could have been put to work up till a certain point. I guess
I think that point, Asad, is the main point, which I was just thinking of, which is up to a certain point. Because as we're talking about the ability for people to build small bootstrap businesses, I went for a run on Sunday with a guy that's the chief product officer for a go-to-market sales tech company who's talking about building like small AI powered services that are all PLG, and getting to a place where they're like $10,000 and $20,000 a month, so basically like $400,000 or $500,000 in ARR total, and then just building the next one. And I think that there's a market for capital there, but it's just it's the pre-seed. It's micro VC. Like there definitely seems to be like a market for cutting $250,000, $500,000 checks and then optimizing for an outcome that's a $10 million outcome or an $8 million outcome. But I think the place that's gotten the most squeeze, which we've talked about, which you had in your report as like showing a little bit of optimism, which was great, is Series CD of like the growth equity rounds where you have to deploy $100, $200 million in capital. Now, on the other hand, there's people that have been able to raise that recently, so that's good. But it's like you're deploying $200 million in capital because you're pursuing a multi-billion-dollar outcome, and those seem much harder to come by.
Totally. But there's a part of me that thinks to the overall thesis that the market could have, also to your point, the market could have taken in more capital and used it fairly efficiently over time. But perhaps we're at that equilibrium point where that's no longer the case. I think the real question is, if that is true, what happens to late stage VC, and do the LPs do something else with their cash? Because one of the things that's become very clear from our data over the past 2 years is that VC funds are not a 10-year proposition. They are a 12 or 15-year proposition, right? And at that level of illiquidity, so that's a 50% increase in illiquidity. The premium that you need for that illiquid cash has to be meaningfully higher if you are not just going to put that into a PE asset class where the turnaround is actually 3 to 5 years, et cetera. So there's a part of me that's like, what does the LP base think of the premium within illiquidity and venture? And do they value it at the same at 12 or 15 years as they do at 10? I have no idea what their answer to that question is.
Yeah, that's really interesting. It seems like there's a space that is unfilled but is emerging, which is traditional venture. There'll always be traditional venture, but there are limitations to how big that sector can get because the sector is built to fund companies that build something that takes off, and there's only so many things that can be built that take off in any given year. So it's going to hit like an inflection point. Maybe it has. You've got private equity, which likes to get in when they feel we can buy this asset at a fair price, do X, Y, Z to increase its value over the next 3 to 5 years, exit it. But what was really missing was startup capital for somebody that didn't have a venture scale idea, but had a good idea, but was too early for PE to be like, I'm interested in this.
Right.
And so that's the space that's missing, because right now, if you've got a bunch of money in the bank, you can bootstrap. But for most people, bootstrapping is really hard. Like the barriers to entry in bootstrapping are, do you have the money to sustain yourself and your idea during those early days to figure out if you got something? And most people don't have that money. Like Adam Robinson had $1 million in the bank because he was a trader. Like, most people don't have that. And so there has to be something new that emerges that is built to service that type of company, the company that is going for $10-15 million revenue type of outcome, and isn't going for venture scale, but still needs capital to get started. And there isn't much there right now. Do you see anything there, Peter?
My instinct is that part of the market is actually getting better. The question for me is, so this actually relates a lot to the idea of location, which is a constant debate in venture, which is, okay, it kind of depends on where you are, right? In Silicon Valley, I actually think that is not true. There's a lot of 500K checks lying around on the sidewalk here in San Francisco if you're willing to pick through the trash. Like,
is that even if you don't have like a big TAM, big idea type of thing? Like if you're trying to build a business that's like a $10-20 million business, can you get that money still?
I think it's a growing segment. Look, the question is, are you upfront about your desire to build a $10-20 million business, or are you saying, hey, I'm going for venture scale, and then it's like, hey, actually, thank you for that 500K check?
Yeah.
I think that both of those things are happening for sure. The question for me, as we watch these ecosystems grow, so like the question of, for instance, Miami, we put out some data on this recently where it's like people get up in arms about Miami, probably because Keith Raboy is super loud on Twitter and whatever. And it's always like Miami is crushing it, or Miami is a backwater and never going to be anything in venture. The weird part is that both of those things are true. And the difference is by stage. If you look at just pre-seed capital, Miami is in the top 10 firmly and moving towards the top 5 of ecosystems on Carta. It's happening. If you look at general venture capital, which again, this is huge asset class, Miami isn't even in the top 25, right? Because there's no late stage capital in Miami. But if you just focus it on those,
are the top 3 Bay Area, New York, Boston?
By far, yep. And San Diego for late stage biotech. But it's very interesting to watch these ecosystems grow because they have to start with small capital. Of course, you're not going to start with late stage capital, most likely. Yeah. So you grow from the bottom up. And I do think it's actually easier it doesn't necessarily answer the question of whether or not those founders are going for traditional venture scale outcomes or more bootstrapped M&A outcomes. I think both are going to be happening, but it does seem as though venture as like an idea almost or a mindset has to get firmly rooted in a place, and then the ecosystem can grow. And we're seeing that happen in more places across the country. It's pretty cool, honestly.
So what are some of the faster growing ecosystems?
In our data, some of the ecosystems that are doing pretty well, Houston is one of them in terms of growth. Miami at the earliest stages is growing well. DC is has always been kind of like on the fringes of the top 10, and I think has firmly sort of made itself more of an ecosystem. At the much smaller places, you go to the third tier, it's places, more like Charlotte or Boise or places like that, which really probably could never get to significant scale. There's just not enough, to your point, not enough babies, not enough people. But in general, we're seeing those top 3 markets, which are Silicon Valley, New York, and Boston. Those are firmly entrenched as the mature ecosystems. And the second tier of ecosystems is just getting wider and wider.
I find that this explains a little bit of Toronto's problem, because Toronto has a really good education system that brings out some really sharp technical people. And if you look at even the AI boom that's happened, a lot of the early research that led to this boom came out of Toronto. But then you look at the Toronto ecosystem and you just click in and you're like, what's happening? The Canadian ecosystem as a whole. And it's just not vibrant enough. And 95% of my time is spent with US companies and investors, 5% in Canada. And that's partly I've realized by design, because whenever I spend a lot of time in Canada, I get depressed. Like they play a very defensive game and I get very excited when I'm in the US. Like everything's more interesting, exciting, and on the front foot. I think part of it is the venture infrastructure here. We don't have a lot of really great firms and a lot of great investors. And that is a problem in this ecosystem, because then that creates a lot of trouble when you're trying to fundraise. And so you would say, well, that type of trouble is in an inability to fundraise. It also means an inability to even go and pitch ideas, because there's no psychological safety that when you pitch your idea, let's say you're an employee at a company and you pitch your idea to an investor, there's an unwritten rule that the investor might know the company that you're working at right now, but they're not going to tell that company you came and pitched, right? Like, that's an unwritten rule in venture. That rule doesn't necessarily always hold true in Canada. So the psychological safety isn't even there. And so there's the foundation of an ecosystem has to be great investors that then enable these people that are coming out with the ideas. So you've got these two institutions. You've got universities and colleges that are bringing out technical talent. You've got investors that are enabling them to move forward. And then these two things collide. And you've got government regulation, tax rates, etc., that will either slow or increase its speed. Canada has one really good and two really bad. Great universities, horrible regulations and tax infrastructure, and pretty substandard investors. And that's really held this market back, which I find quite interesting. Do you guys look at the Canadian market at all?
We do. I'll speak up for our Canadian investor friends. I know quite a few great ones. But I think the thing that you've touched on is there is sort of a cap at which the scale just really isn't there. And some of this is just, when you talk about other ecosystems across the world, like London or Singapore or other places, you hear founders saying, "Oh, I'd like to go to the US market," or "Hey, yeah, when I get big enough, that will be the next pivot." In Canada, that's just much more real. I mean, it's literally right next door, right? There's not that much work you need to do it. It's a bit of a easier shift for many founders. So we do see that happening. I'm pretty bullish on Canada um as like entrenching itself in the next tier of ecosystems, Toronto in particular, I think.
Yeah.
But there's no doubt that, in terms of big exits, et cetera, you're still looking to the US. I wonder if this actually gets back to another question though around that Sam had posited about, like, do we need a different set of angels who are not looking for venture outcomes? Or like, is there an education required for angel or pre-seed funds where what we need is a new class of pre-seed fund that is interested in the bootstrap single round indie VC model? And that will be like a very clear pathway between traditional VC and whatever we're calling this one and done round kind of thing.
I think the answer is they're out there, and to your point, like the lack of naming convention and a taxonomy.
Mm-hmm.
Yep.
My guess is that it probably hurts the founders more than anything, because my guess is that these folks materialize with punitive term sheets when the founders can't, they're not quite a venture opportunity. And so they start looking for other people, and those other people maybe have emerged from private equity. And so, Asad and I know, no, I don't know that the person I'm referring to doesn't deserve these terms, but nevertheless, we know of some companies. It's not venture. It feels like private equity, and it's these massive. If you don't hit these ARR targets, then our warrants double, and if you don't hit this target, then we go from owning 20% of the company to 40% of the company, and we get 2x liquidation. And I think the lack of a platform, meaning like the lack of like a systemic way of labeling that type of investor and categorizing them, it just creates a lot more volatility and variance. I mean, that's again, like the beauty of like, the term sheet. The beauty of the venture capital industry was that, again, like there is they're not. You can say what I mean. I don't know Keith Raboy personally, but nevertheless, like the reality is there are standard terms, and you can Google them.
Yep.
And when a term sheet is clean, especially with ChatGPT versus
100%.
not, and that helps. I was just thinking about while we're talking, like platforms help, and one of those platforms can be standard terminology. Language can be a platform. Regulation can be a platform. All of it, serves to increase the liquidity, and that liquidity can be the exchange of ideas. It doesn't necessarily have to be the exchange of capital. If everybody speaks the same language, it just makes things easier, even if people don't like the language. Anyway.
If there's one thing that VC can take credit for and has done supremely well, it is brand themselves, right?
Yeah.
It is now the standard pathway that many founders think about when they think about entrepreneurship in general, which is kind of crazy given what
It is totally
VC
insane.
really is,
Yeah. And Fred Wilson has a lot to do with that, I think. Fred Wilson and Bill Gurley and
Yep.
and it really is interesting.
Fred unleashed a monster that he now probably dislikes in some ways.
I'm sure he's a pretty grumpy guy.
And he's still he's in the office all the time, investing actively. Like, it's so fascinating. I think that's the point that we were discussing a little bit earlier, which is that right now, if you're that founder that doesn't have the big vision but wants to build something, there isn't something specific for you today. And so, Peter, as you were saying, they might have to sell a bigger vision to then go and get the money to then just play their own game. But I find that exercise, when I sit with, I once, in every given quarter, maybe a couple of times, I'll see one of these decks that they are taking to investors.
Yep.
And I find that in that moment in time as an entrepreneur, when you're starting your business and you're looking for the first round, that confusion of like, my idea was this that I'm really excited about, but I need to now twist and turn it to make it investable.
Yep.
And I need to now find excitement behind that. It's hard to get excited about the idea that wasn't the big idea, right? And it's usually, if that was, it ends up being, the original idea is actually a really interesting business that somebody could build and benefit from. Usually what they have to pitch doesn't end up being all that exciting, all that great. They don't have the conviction behind it. They feel sketched out doing it sometimes, right? Like, some founders are conscientious people where they just feel off. And so that creates a lot of hurdles for those people that are trying to raise. And so it'll be really nice as this ecosystem evolves, where somebody comes up that is built to service that person. They're raising money from the LPs with the cycle of those investments in mind, the returns of those investments in mind. They're thinking about fund deployment accordingly, because you won't play the power law the way you will in a venture fund, right? Like, if you're trying to invest in those companies. So that coming out of an ecosystem, I think, will be fascinating for the ecosystem. And it seems like things are moving in that direction.
The difficult part with, when we talk about brand and building a unified taxonomy is, if you go with the bootstrapped or one round model, you don't have set milestones to check back in on that company unless they're willing to share their ARR, right? So, like, part of the reason why venture gets ensconced in the media is because you can talk about a Series A fundraise.
Yeah.
You can't talk about a bootstrapped company that just hit 10 million ARR unless they give you that information, and there's really no reason to do that. So there's like a structural media, people talk about product market fit. There's like a structured media fit with venture, where like you check in on these companies over time and people get excited about it. That doesn't
is
exist.
that excitement still there? Like, does it still matter? Like, does an article on TechCrunch about your Series B really matter?
No.
I mean, what do you mean by really matter? Does it matter in terms of,
does it do anything for you in a real way? Like, you'll share it with your friends, you'll share with your mother, your employees will get excited, but then does it drive a real needle? Does it drive a pipeline needle? Does it drive a revenue needle? Does it help with churn? Like, it feels like when I started off, like, I remember when I was in university, I had a startup, and I remember at that time, TechCrunch was this powerhouse in the ecosystem.
Yeah.
It feels like that type of publication that is basically a PR channel. Like, the ecosystem has gotten so large that we're talking about an ecosystem growing at 7% per quarter with hundreds, 100 and something thousand companies in it. There's just too much of that news for that news to really matter.
I don't think that an individual company announcement matters very much at all. I mean, whatever, individual companies might disagree with that. The point that I'm trying to make is, it's difficult to track bootstrapped companies.
Yeah,
there's no like, it's the conversation around them doesn't have natural anchor points the way that I can put out a report saying Series A valuations are X.
Well,
if you only raise a little bit of capital and you don't ever expect to raise a Series A, you're not in that data, and the data ignores you, right? So like, it's like, in terms of how to have the lattice work of a conversation around bootstrapped, it's just much harder.
Yeah, because right now, if you see somebody release a Series B, you can at least say that revenue is trading in this range, probably, right?
Totally. And like, I talk about Series B as a category, whereas bootstrapped is just like, okay, bootstrapped is a category, but there are companies in there like MailChimp before they got bought, and then there are companies in there that are just starting out. And it's like you just got to dig into the specifics more, and those specifics are harder to get a hold of, and all that stuff. We're talking about building a
conversation energizing personally, because I feel like this is a moment of disruption and dislocation. Like, we're living through this moment where things are changing quite rapidly and there is no playbook, or at least the playbook's being rewritten.
Yeah.
There's so many companies I'm advising or talking to that, where for some of them are being somewhat stupid, but many of them are being much more intelligent about
which ones are being somewhat stupid.
Oh, Peter. But I find that like the awareness of hey, there's different kinds of capital. We don't have to raise money. We could raise this kind of money for now and never raise again.
Yeah.
Creates so much more different paths. And because I'm thinking of a company that's doing it well is this company Fixer that I advise, and they. Whatever you think about the product, the reality is they built it extremely efficiently. They're getting to $1 million in ARR very quickly. And they are keenly aware as well that like they have many more paths to capital and to success than simply getting on the merry-go-round and going seed, Series A, Series B.
Yep.
And that's cool. I think that's really, really cool that you can do that. And that one of the choices that we all have now is like, how do we want to build? And, some companies, I even see it in the community space, where, I'm taking effectively a much longer term view. And then there's other companies that are like, you know what, we're going to build to sell and it's going to be about EBITDA. And that's what I'm going to do. And I think that the optionality is really exciting and energizing because it means that it doesn't, to the point of one of the deflating things about, I'm sure this is how it feels for like actors in Hollywood sometimes. And this was the deflating thing about 2021. You're like, to Asad's point, you're like, why the hell, how did that person raise $100 million? They barely have a product. And, their main point of advice is never put together a deck.
Right.
And you're like, that feels
play League of Legends during the investor meeting.
Yeah, exactly. Yeah. So it's like, I don't know, it feels more grounded and it feels like there's opportunity. That's my takeaway.
I love it. We need more cheerleaders for that sort of ecosystem. I basically, Sam, when I'm looking out in the media environment and saying who's cheerleading that push, it's you, and it's Bryce Roberts at Indie VC, and it's who else? Like,
yeah, I know. I'm getting
I don't see a ton of people who are like making that.
I get back channel negative feedback saying stop talking about it because it's there's fewer people that are coming to me for money.
I'm
like,
unsurprised. I am completely unshocked by that.
Yeah, that's fascinating. I think this is why it's so important not to think about going back. Like when we talk about, like a lot of our go-to-market consultancies in the market keep like pegging us to this old benchmark in various numbers as this is what good looked like, and we need to try to get back to that. And I just think that, Sam, what you said is so correct across the board, which is we're at an inflection point. This whole thing is evolving in a bunch of different areas, and a new form is going to show up. And if you're trying to get back to the past, you're going to miss it. You just have to go first principles and ask a bunch of questions up now that are based on the reality of doing business today. And so an example is maybe the reality of today's business is that go-to-market is becoming more expensive. But the other reality is I've spoken to a number of companies that are very successfully offshoring. And because they're offshoring their technical teams, their support teams, some companies are offshoring their sales teams when they're doing SMB motions, their P&L looks completely fine, actually better in some cases. And so they were doing this from a first principles based perspective. They were building that infrastructure out in 22 and 23, and they're killing it right now because they weren't trying to just get back to this old thing and the old way of doing something. They're like, there's a new world. Let's go and figure this out. Let's discover it. And I think that's what's really exciting. And I'm trying to stay true to that myself as well.
Also, I want to make you a hat that says "Make VC great," and then parenthetical for the first time. It's going to catch on. I think it's going to catch
as a branding. This is why he's an influencer, folks.
See, this is it.
Why he has
We're going
more followers than me.
It'll be bright red, and it won't be confusing at all.
We need some swag. Like we need like drops, like controlled drops of like 50 to 100 pieces of these things every few months. we are coming to the end of this. So can we do a quick fire with you, Peter, on this one point, which is the combination of early stage and AI. Early stage funding was down, but then there's this AI boom that's happening.
Yeah.
That was the one thing that I was like, oh, interesting. And so the more I sat with it, I thought, well, if AI is still raising, it's still subdued compared to like a few quarters ago, A, and then B, all those non-AI businesses are having a tough time raising. And so there's like a recalibration that's happening. How much of it is that? Is there another reason for this? Your thoughts on the intersection of those two things?
Look, I mean, the quarterly numbers will bounce a little bit up and down. In general, I think there's two things that are true. One, AI is definitely, I don't want to even call it a hype cycle. It's like cemented itself as this paradigm through which other investing is viewed. It's about 30% of the cash invested into companies on Carta goes to AI companies. That's pretty in line with what you see from other data providers. What that means is two things. One, yes, it's AI companies are raising at different valuations, at different fundraising paces, et cetera. Two, it is not impossible to raise without AI. I don't want to keep telling ourselves this story that only AI companies are getting funded. It's not true. What you, as a founder, you absolutely need an AI story. If you are not going to predicate your company on AI, you need to tell investors why you've done that. Are you using it in your tech stack and you're just not referring yourself that way because you're candidly more open and honest about it than most other founders? Like, whatever it is, have the story. What we've seen a lot is that AI has moved from the title slide to the tech stack and saying, yes, we utilize AI in this way. It's made our operations or XYZ much more efficient, blah, blah, blah. But the reason the company exists is because we have a unique customer insight that was there before AI or not predicated on the development of that technology. And I think that's great. I don't think the AI premium for non-infrastructure companies is going to last for that much longer because all the founders that we're talking to now are utilizing AI in various different ways, and they're just trying to use the best tech that they can.
That's fantastic. That's a great place to end this episode and go into shout outs. Peter, you've done this often enough.
You're willing to be 1 minute late. Thank you, Asad.
1 minute late.
He's an angel, folks.
Can I do the first shout out in case you guys have long ones and I actually have to draw?
Yes, go for it.
Yeah, of course.
Okay.
But just leave your browser window open so that it can upload the thing.
I want to shout out short form creators. So this week, I decided a couple of weeks ago that I want to learn a new form of content, and I see short form video on LinkedIn taking off. So I just want to learn it because I think it's important to try to do things every couple of quarters where you suck and you have to get good. I think it's a humbling exercise and it's interesting and it's exciting. So I'm trying to learn what short form is all about. And I spent a couple of hours on Monday recording a few videos with a guy that I'm working with. And I just came away with just so much respect for those people that do it. I did not realize how hard what they do really is. Because if you think about it, you're just trying to distill something that you can explain nicely in 10 minutes into a minute. And you're trying to get to its essential truth. And that is so hard to do. It is so hard. Your brain hurts when you're trying to do that. And then these creators, a lot of them are shooting it themselves, editing it themselves, like coming up with the content themselves, like promoting it themselves. It is my respect for the short form creators that are really good, just shot through the roof. And so shout out to all those people that are doing that.
Thank you, Asad. Peter, you go next.
All right. Self-serving shout out here, but I want to shout out two people at Carta that are now like expanding my world of insights. So Ashley Neville, Hamza Shad, my insights team here, finally like not doing this thing alone. It's been amazing having teammates that you can bounce ideas off of. And we've got like, you think these reports are cool? This is Stone Age stuff to what we're going to be doing in 2025. So super psyched to have a great team.
That's amazing. 2025. I can't believe we're almost there. I'm going to shout out Robbie Kelman Baxter. Robbie is our newest board member. She's written 2 books, The Membership Economy and The Forever Transaction. And every time I talk to her, she helps. And it's just so nice to talk to somebody where you say, I'm struggling with this problem. And she says, well, 15 other companies have solved that exact problem this way. So unless you're a very special snowflake, consider this a suggestion, but not a mandate. So Robbie, if you're out there listening, thank you so much. She also runs her own podcast all about membership businesses like Pavilion. And with that, Peter, thank you so much for joining us. Peter will be at the CEO Summit in New Orleans on January 22nd and 23rd, hosting, first of all, you'll probably have some fresh data, I'm sure.
I'm hoping.
And then hosting and moderating an investor panel on the state of the market. So if you're a B2B CEO out there in the technology ecosystem, you're listening to this and you're not coming, you can meet me, you can meet Asad, you can meet Peter, you can meet Bob Moore from Crossbeam, you can meet Jocko from Winning by Design, you can meet AJ from QuotaPath, and a ton of other people. What are you doing? It's going to be awesome. Where do you want to be in January besides New Orleans? Let's go. Peter, thank you, sir. And we'll talk to you soon.
Anytime, Sam.
This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.